NDTV Profit.
Hello and welcome to NDTV Profit. The mood around the Indian economy certainly seems to be getting worse. Data points have also suggested that perhaps things are still looking quite worrying for the Indian economy. Have the optimists' belief in the Indian economy been shaken? Joining us, someone who's himself called himself an incurable optimist, Mr.Aditya Puri, MD of HDFC Bank. Mr. Puri, thanks so much for joining us.
Welcome.
Simple question. Has your optimism been shaken?
No. No. I don't think the optimism has been shaken, but am I starting to get worried? The answer is yes. Because I do believe that the fundamentals of the economy in terms of our structure, in terms of our benefits going forward for the country has not changed. Yes, we have some problems. And I have to admit that even though the problems have been identified, solutions for them had been specified in the budget, why there's so much uproar when logical actions are being taken, and why we are restrained from taking the balance of the actions. I have to tell you, I don't have enough knowledge of how politics in Delhi works to give that answer, but everyone knows what needs to be done. It's not that complicated. And if we do it, we don't have problems like the rest of the world. Structurally, we're still a good story.
Mr. Puri, let me start with one factor at a time. If you look at, say, the growth numbers, the Q4 GDP numbers obviously shook everybody. 5.3%. Dr. Rangarajan himself came and said that even for this year he's looking at 6.5% to 7%. So we're now not even talking about a 7% kind of economy. We're probably talking about a sub 7% kind of economy.
That's because we delayed the action. The fact of the matter is that what is the issue? The issue is there's no investment in the economy. Then it gets linked to interest rate. That gets linked to fiscal deficit. That gets linked to liquidity. The longer we delay taking actions on subsidy, on investment, on import control, the time gets short. So, for instance, now if you only do 6% in the first half of the year, if you want 7% growth, you have to do 9% in the second half of the year, and that won't happen. So I would say this should be a call for action, not despair. And that's why I say I'm still an optimist, because I do believe that we should all get our act together. There's no point everybody blaming each other. There are things that everybody needs to do, and I hope to God we do them.
But the message does need to go out that this is no longer a slowdown which has been brought on by global factors. Yes, that is one part of the overall story. But for instance, the investment side, this is not a slowdown which is brought on by the global economy. This is about decision making, right? It's not even about large ticket reforms. It's just about on the ground decision making.
Absolutely. I think to blame global factors for a 6% growth rate is wrong. Global factors, do they have an impact? Yes. For instance, if you take the exchange rate, if you just see interest differential, somewhere in the low 50s is where our exchange rate should be. The overshooting that has happened because of global factors and flight to risk, etc. So have global factors had some impact? Yes. But are they the major culprits? I would say no. And I think you're specifying correctly that we have to get GST, we have to get direct taxes, we have to get the power projects going, we have to get the coal issues sorted out, we have to get subsidies to reach the right people and not have them wasted. A lot of these are not major decisions. These are not even great policy decisions. Those have been taken. So I come back to the same thing. I think we all know what needs to be done. I'm frankly foxed why it's not happening.
So there is a bit of disappointment, not just for you, but generally for the community watching India in terms of just the policy making sphere. Do you think our politics has let us down more than anything else?
I think, I'm against this policy paralysis business. I don't think there's policy paralysis. We may probably be having the same thing at the US, which is a political gridlock. Because there must be something, the individuals, without talking about any specific individuals that we're talking about, are very bright and competent individuals. So there's something that is impeding them, which I can't put my finger on, and it could be politics, I don't know what it is, where their defined actions, which they say must be taken, are being delayed.
So just looking forward, Mr. Puri, on the investment side, has nothing moved over the last, say, 3-4 odd months, or even for this year, calendar year? Has anything moved for the better, or have things gotten worse, or are things static?
I would say they're close to static. The issues remain. We all know the issues, that if you You need faster approvals. You need the mess on the power sorted out. You need the government to kickstart investments. You need a clearer picture on the interest rate. And I think those haven't changed. Until they change, you will not get the investment. Till you don't get the investment, you don't get high growth rate.
But the consumption side of the economy, has it more or less held on, or is there signs of crack there?
There are signs of slowing down on the consumption as well, because if inflation carries on and you don't get wage increases and you don't get that much investment and employment increase, then sooner or later the consumption story, while there's nothing alarming there, but is it starting to slow down? I'd say yes.
So the other sort of incremental set of worries has come in on the external side. You alluded to the rupee. I just want to get a sense from you on how you see the, say, the movement of the rupee per se. Volatility, sudden steep downslide may have hurt corporate India, but enough people are making the argument that a weaker rupee may benefit us in the medium to long term. How have you seen the sort of, firstly the currency factor moves?
See, the currency is fundamentally demand and supply. We're running a current account deficit. The flows have not been enough to meet the current account deficit, so we're net short dollars. In addition, there's been a flight to safety. So that's the cause for the decline. To some extent, that cause in decline, that decline has negated any inflation benefit we would have got on our imports. But as long as we are a larger importer than we are an exporter, a weak currency is not a great idea.
But in terms of benefits of import substitution, eventually sort of demand...
Those are long-term benefits. See, you have to understand that import substitution and higher exports, by definition, have to come, and some amount may have already started, which you've seen in the import slowdown, that yes, there will be import substitution, and since the rest of the countries, our main competitor, China, has not had a weakened currency, we should be at an advantage. These are not things that happen quickly. If you want to fix that in the shorter term, you have to handle the import side of it, and you have to get higher FDI, which is you sort out the coal policy. I think we did something on gold. I don't know why we reversed it. And you look to see items that can be exported. So a combination of capital flows, lower imports is only what is going to fix it. But if we fix the issues that you've been talking about, at least from my talks with the institutional investors, there's a lot of money waiting to come in. If you see what is happening today, I think people realize that in the long run, we have a structurally good story, but there is a problem with the US and European story. Europe, a big problem, but so does the US. They probably have to have quantitative easing again. So for people who want to invest in the long term, this still remains a good idea, but we've got to get our basics right.
So you're still saying that capital flows could come back on the assumption
that absolutely. I think if they raise diesel price, that means that we would be able to show to the rest of the world that when they say we will have action, we will have action. And if we then start to have a rational review of our subsidy mechanism, whereby those subsidies, which we really don't have the leeway today to have subsidy not reach the end beneficiaries, I think it'll work straight away. And I do believe that maybe the gods are favoring us. I think oil price will come down. I think we should see some improvement in our rupee exchange rate. And so just let's hope we do diesel and one or two other things, and you could see a change in sentiment.
Okay. But sir, when you hear of, say, Morgan, CLSA, all of these brokerages coming out with the excessively bearish, some are saying 5.8% for even FY13. So you're saying that even numbers like that is not enough to sort of scare away foreign investors. They still believe in, say, the medium-term story. So at least FDI should be strong, even if, FI is not?
FDI is not related to that, because the FDI looks
No, but what
at
if people are questioning your long-term story is my point.
I don't think the questioning of the long-term story is correct. And whereas I don't want to take a pot shot at Morgan Stanley, CLSA, I think they could also do with better estimates rather than just blaming the government. Their estimates in a lot of cases are wrong. And that's when I said that let's have an call to action rather than despair. So every time you talk to them or you get onto this TV, if this happens, if this happens, if this happens, then what will happen? Well, India goes to bits. Why not think, what if oil price falls and the commodity prices fall and we raise petrol price, wouldn't we be kings?
May not be kings, but we may not be paupers.
Okay. At least we're getting somewhere.
Okay.
So I think there's, those guys have gone a little too far. I think Dr. Rangarajan, when he stated, has given a very fair professional assessment that yes, we need to cut our fiscal deficit. We need to raise diesel prices to show that we are bringing our fiscal deficit under control. We need to make sure that we remove the impediment to investments. I think if we do that and very quickly sort out, as Adi Godrej says, sort out our GST, I think we still have a great future.
One other question on the current account, sir, before I come to the fiscal side. There were all these comparisons around 1991, external crisis, and there were enough voices talking about that. You're smiling even before I finish my question. Are those overstated? Is there any chance that we could see an external sector kind of crisis?
Absolutely not. I mean, we still have a lot of reserves. And, we haven't even moved to take any kind of action. But the real deficit is petroleum and gold. You would agree I can stop gold anytime without having too much. We keep talking about this argument that it will go to smuggling. Okay, let it go. At least it doesn't affect my current account deficit. So, no, I don't think there's anything of the sort. I think we're safe and sound. Let me repeat again. We're running out of time. We need to take the action. But a call to despair is not required.
And you're saying, a lot of people have pointed this out. Just one single move on, say, cutting subsidies on the oil side would have a significant impact, whether it's material impact economically or sentimentally. Either way.
No, I honestly do believe that if oil is below 100 and there is some change in the exchange rate and we get our deficit under control to some extent so that there is no crowding out as well as interest rates start to come down, I believe that's enough of an action, and at least it shows that the balance period of the UPA, they will take action that is warranted. I really don't care about FDI and retail and whether insurance is at 26% or the voting cap on banking. But we have to get our agriculture policy right. We have to get the approval policy. We have to make it much easier. We got to get the center-state relations right.
So basically GST, subsidies, and center-state relations. Would you say that those three?
Yeah, that's it.
And then there's interest rates, which I haven't gotten to. Do you think sort of room is opened up? We've seen.
I think people would be surprised with the interest rates. I have two views on interest rate. One, I think there is a shortage of liquidity. So I do believe that if you want deposits to grow, deposits are growing at 13.8 odd %. That's because money supply is not growing. You need money supply to grow at 15%. So I very much would like a 1% CRR cut, which would bring easy conditions in one odd %, which would make the conditions easier and in any case reduces the cost of funds for banks so that they can pass on at least some benefit to the end consumer. I also believe that if we now look at it, yes, headline inflation is an issue, but core inflation, which reflects demand, which is the only thing that interest rates can affect, actually has moderated. And if we take what's happening to oil, what's happening to commodities, and what's happening to the rest of the world, then you can't have both things. The rest of the world going down, we continuing to have a high interest rate, a high oil price, and a high commodity price. That doesn't work.
So a couple of questions. One is a more theoretical question. So, for an economy like India, even if it's, say, food inflation, which monetary policy cannot really directly control, but can we afford to have, say, continuous years of 7% plus kind of inflation? Isn't that detrimental for an economy like India?
I think so. I think it is. I think there are issues on the agriculture side that we have to address. So whether they're the issues of storage, whether they're the issues of the cold chain, whether they're issues of productivity, the fact remains that we have the second largest arable land mass in the world after the US. We have third more arable land than China. So look at the potential if we get our irrigation right, if we get the right crops, if we get the right cropping patterns. And maybe we need to have a look. Why being far off an agriculturist myself, if you say pulses, I don't think pulses can be a structural issue because you don't need a factory. God's given us land. So you just have to make the conditions conducive for him to do that. And maybe you sell your surplus food grains and buy what you're deficited. But I think there are lots of small things that have to be done. And that would be good. I found my friend Arun Maira from the Planning Commission on TV recently. And that's what he said the Planning Commission is saying as well. Fix the things that need to be fixed in terms of accountability. If you spend money, I must know where it was spent and did I achieve my objective. So you have to have outcome based, just like you have So you need the accountability. Do you need to cut red tape? Yes, you need to cut red tape. You need clearer definition between state and center? Yes. I think those things are required.
But in the absence of, those measures, and again, it comes down to the center the government taking these measures, which, when it happens, God alone knows, I assume. But in the absence of that, would you say that the central bank then needs to not hold up the rest of the economy through high interest rates? Or, for them, it's a tough call as well.
You can't make the central bank the panacea of all your issues. I think the central bank has been saying clearly for a period of time that, look, I can take action, but if you run a large fiscal deficit, structurally, interest rates are not going to solve the problem. You can't run a large fiscal deficit and have a declining interest rate environment, and especially if you take that fiscal deficit that you're running is running for unproductive expenditure. So the capital efficiency has gone down by 25%. So if you're not sorting out supply and you're creating demand and then you expect the RBI to continuously move, I don't think that's feasible. I don't think the monetary policy is a substitute for appropriate action. It can aid proper policy. It can't lead it.
But then how can we expect them to cut rates substantially?
Just now, there's rates, two things. I'm saying as of now, it is a reasonable presumption to presume that if the core inflation has moderated, oil prices sub 100, if the world is not going through pretty good times, there will be further decline in commodity prices, and there is a slowing of growth, that there is not a major likelihood for interest to zoom up. And even if RBI takes an action, they're not going to say they're just going to make it so easy that they create superfluous demand. But they could put some liquidity and take a bet and put some interest rate. But will that solve the problem on its own is all I'm going to say. The answer is no.
But it'll help. So it'll help the investment.
It could help temporarily. No. I don't think there's enough. Investment is not based only on interest rate. So if you don't sort out your impediments in terms of approvals, in terms of power supply, in terms of your raw material policy, in terms of your land acquisition, interest rate alone can't do it. You've got to have all of it coming together.
So if there is interest rate cuts right now, what does it help? What does it help if it doesn't really help investment? What does it help? I mean, consumption, in any case, you're trying to moderate, right?
An interest rate cut at this point of time could probably, some of the industry would look at it as reducing their costs, their margins. And frankly, if inflation has gone down, our interest rate is high anyway. So bring it to a more realistic level. But if you're expecting major interest rate cuts, I think we may be on different planets. You and me.
No, I'm not. I'm asking whether there's reason. I'm not expecting any.
I'm saying there could be, but not very major. And you could see some liquidity measures. And a combination of these would be helpful. But I'm also saying that running of the economy, RBI can help, but it has to be run elsewhere.
There has been a criticism on account of the banking system as well, because the RBI has done, 125 basis points on CRR, plus 50 on repo, and all we've gotten is a marginal 25 to 50 basis point reduction in actual rates.
That's correct.
Isn't that, I mean, is that fine according to you? I mean, that's, the differential between what the RBI has done and what the bank has done is quite big.
Yeah. Well, you don't have to be apologetic about it. You can ask me, and I think it's fair. The issue is that there is, what the RBI has done and the indication, yes, the banks could have brought the interest rate down, provided there was enough liquidity in the system and the deposit rates had come down. Because of the shortage of liquidity, deposit rates haven't moved. So when you see the funding of the banking system in India, it's 90-odd% deposits. So if those costs don't change, then what do you expect the banks to do? So the signal in the long run by the RBI is correct. Some amount the costs have come down. 100 basis points cut in CRR bring the costs down by about 10 basis points. So have I answered your question?
Partly because liquidity has eased up. I mean, it's still tight, but it's not, plus 1 lakh crore kind of injection.
It is. It's back again. The only easing you saw was that was fortnightly closing that it went down to 6. See it to the end of today. It'll again be 110. So the point is 110 is not easy liquidity. 40, 50,000 is easy liquidity. So if you take the deposit rates today, the deposit rates are exactly where they were. And they're exactly where they were because there is a shortage of money. And if the deposit rates don't change, then there will be some transmission, but major transmission won't happen. And that requires more money.
So, from the banking system perspective in terms of credit growth, deposit growth, I mean, the numbers that have been put out in the annual policy and also for, HDFC Bank, those are more or less doable, or do you think we're going to have to see a downward adjustment in those numbers, targets?
See, they are a function of GDP. So the number that had been put out was an expectation at 7.3 GDP. I think that 7.3 is also starting to look optimistic at this stage. It's probably 25 basis points here or there with a bias downwards. So automatically that leads to an adjustment because the credit, normally the multiplier of credit to GDP is about 2.5. So at 7 you would have about 17.5% credit growth, which is where it is. But we need 15% money supply growth, which the RBI said we would have, which we don't.
Okay. So, I mean, in terms of for HDFC Bank, what would that mean? And also the structure of the sort of the mix of the lending.
No, the bank, God is kind.
There the decisions are easier.
Yeah, the bank is easier for me to see. If you see, we substantially expanded our deposit network. We, contrary to a lot of opinion in terms of being urban-centered, actually took a lot of our products to the interior. So a lot of the products that we offer in the interior, we are one of the few banks offering them. And we meet our credit deposit ratio in almost all the states. But more importantly, that allows us to participate in the rural demand. And I must say the rural demand is healthy and growing. So we have not faced much pressure either on growth or on margins or on delinquencies. What else is left?
Nothing actually, but on delinquencies, I mean, I know you haven't faced pressure, but industry-wide there's quite a bit of concern, particularly on restructuring.
Yeah, I think this restructuring bogey never seems to go away. We heard the Deputy Governor, in fact, I read his, I think it was in the Economic Times that Mr. Anand Sinha had said. Is there restructuring? Of course there's restructuring when an economy is slow. Is all restructuring flowing straight into bad assets? I don't think history tells us that. So, yes, there has been restructuring. Will somewhere between 15 and 20% of that move to an NPA if there's no recovery from GDP? Probably yes. Is that an alarming situation? I think no. The banking system had a gross NPA of 2. It went up to 3. If you take over and above this, you have restructuring of about 4%. If you take 15% moving on to NPA, that would make it 3.6. Net was 2. Maybe it becomes, and that's what my friend Prateep Chaudhary at SBI says, that please look at net, because I think the profitability is good that people will be able to provide for. So I think the concerns on the banking industry and their NPAs are completely blown out of proportion.
And this is, you're already accounting for, say, weaker than expected GDP growth, so a prolonged slowdown, a deeper slowdown, despite that.
So will they go up? Yes, but there's no cause for alarm at this point.
Mr. Puri, just want to close off by getting your thoughts on what's happening globally as well. Europe is looking quite shaky. Would you sort of agree with that assessment? I mean, things could go either way, especially if, Greece, Spain become larger problems than they are already.
See, if you look at it, as far as the US is concerned, they probably averted their crisis by making sure that they didn't go through an austerity mechanism. And since it was one country, they could really pump in money like hell. When you come to Europe, that solution is not available for them because there are multiple countries, and Germany is not willing to ante up, and rightly so, they have their own issues. So Europe will probably have a negative growth rate. There are issues in Europe, beginning with Greece, but then if Greece has a problem, then it could snowball. My own view, I don't think the vested interest, because after all, who's holding Greek debt? It's the rest of the European banks who are holding the debt. And then they will have to restructure the entire euro mechanism. It's not a small issue. So I don't think they will allow a disorderly default, if you may, for Greece. Will Greece finally move out of the euro? I should think so, but on an orderly basis sometime next year. I mean, I'm saying this is my guess. It could move the other way. I would say this is the most likely scenario. And I would also add at this point that this should put a lot of urgency on India to make sure that when this uncertainty comes, and it will come, irrespective of whether Greece gets restructured or not, you are looking at a lot of uncertainty July, August. And before that, I think we should get a few of our ducks in order so that we can see more flight to safety. So foreign currency availability would be limited. And it's important that we get our house in order in terms of making sure what the investors are concerned with, at least we cover that, and what the local people are concerned with, that is the local businessmen, etc., so that we get our economy going.
One aspect would be the financial sector impact, sort of market impact, but then even on the real economy, when you're talking about China going down, their growth numbers are looking weak. The US latest round of data has been quite weak. So, I mean, even from the economic side globally, we could see another bit of a hit coming.
I think 6% takes all of that into account. What we've done now, we've done without help from overseas. But even when we did have the crisis, we were still at 6.5, 7. So India somewhere in the 6 to 7, even with a global crisis, provided we are not too smug about India being different, etc., which has proved to be wrong. I think we are probably well positioned to face it, but we better start implementing.
I'll leave it at that, Mr. Puri. Thank you so much for joining us.
Thank you.